All right, so you're looking at a bunch of homes, but how much house can you actually buy? So let me show you how to pre-qual yourself. So first of all, I want to go ahead and make a very quick disclaimer. I am not a loan officer. I'm not giving you any loan advice. If you do want loan advice, please talk to a licensed loan officer, mortgage broker, or a banker. Okay? In the meantime, I can at least show you what it is that they would want to do or what paperwork and stuff you might need for them to be able to give you a pre-qual, and then you can kind of do it yourself too. All right, so what is a pre-qual? All right, a pre-qual is basically short for a pre-qualification. In which case, what we're trying to do is figure out how much house can you afford based on the monthly payment. You may think that you can afford a monthly payment of a certain level, but the main thing is making sure that we're looking at numbers that a lender or a bank would want to see as opposed to what you think you might be able to afford. All right, so with that being said, let's get to it. So what do you need? First thing you need is, it's easy as 1, 2, 3. Number 1 month of your pay stubs. Number 2, you're going to want 2 years of your most recent tax returns. And number 3, you're going to need 3 months of your most recent bank statements. Okay, so why do you need all that stuff? Well, number 1, the pay stub is to show how much money you're actually making right now. Number 2, the taxes are going to show your history of how much you've been making over the past couple of years. And then the bank statements are really important for a lender to look at because what that's going to tell them is how much money you have in the bank to be able to cover any closing costs, including your deposit, your down payment, and more importantly, what they want are reserves. What are reserves? Reserves basically are how much money do you have saved up in case you lose your job and you don't have any income left, which is always a good idea anyway. But the lender's going to want to see that you have some of that. Now, depending on the lender, it could be anywhere as little as 3 months reserves or as much as 18. It just really depends on your program that you qualify for and whatever it is that you want to do with whatever lender you choose. Now, there's a special ratio that the bank is going to be using to qualify you called the DTI. You may have heard of this before. It stands for debt to income ratio. Now, there's 2 DTIs. There's the front end DTI, which has to do with just your housing. And then there's a back end ratio, which is your housing plus whatever you owe and your credit cards and all that combined. Your max DTI with most lenders is going to be somewhere around 46%. You want to be able to calculate how much mortgage, how much interest, principal, taxes, and insurance. And by the way, also if you have a HOA or if you're looking at a house with HOAs, how much that total is. And also, how much are you actually paying on a monthly basis to your credit cards, car payments, and all the other stuff? Combine that together, and then you want to divide that by how much money you're actually making. So once you get that ratio, you should get a percentage, and that's going to show you whether or not you're going to qualify based on the debt to income ratio. This is a really easy way for lenders to see whether or not you can qualify for a mortgage, and it's something that you should do anyway just to see where you're at. Also, there's a lot of mortgage payment calculators online that you could use where you can plug those numbers in and you can make that work. All right, so very briefly, let me go over how you can calculate your own DTI. So to reiterate very quickly, your DTI is the percentage of expenses or your monthly debt relative to your income. All right, so what you want to do is you want to get your total debt. All right, I'm just going to write this here. Including your credit card debt and other debt, right? And then what you want to do is you want to take that debt and you want to divide it by your total income, right? Now, when it comes to your income, what you want to do is you want to take your gross income, which is all your income before paying taxes. So before Uncle Sam takes his cut, what is your income? That's what the banks are going to use to qualify you for your DTI. So one really good place to look for how to calculate how much house you can afford to buy is actually to go to bankrate.com. So I'm going to put that up right now. So on bankrate.com, if you go to Google, in fact, let me put that up. Go to Bankrate .com. Right here, it says mortgage calculator. That's what you want. There you go, mortgage calculator. Boom. That's exactly what you want. So we're going to pull this up here, and you know what? It's a really good tool because, for one, I don't have to talk about interest rates. It kind of just shows you whatever they think are kind of the averages, and they have their own disclaimers and everything. Of course, they're all based on certain, criteria, so you can always look at the disclaimer and see what they're all about. And you should, by the way. Now, just because they're telling you there's a certain rate here doesn't mean that's the actual rate that you're going to get. All right, so you definitely want to be able to talk to a mortgage loan officer or a banker or a mortgage broker. The whole point is you can kind of play with the numbers here and you can see what payment you're actually comfortable with. So here, PMI. So PMI stands for mortgage insurance, right? So that's mortgage insurance that you're going to be paying on any loan amount that you borrow that's over 80%. So if you borrow 85%, you're going to be paying mortgage insurance on 5%, right? Because that's 5% over 80%. Conversely, if you're putting 20% down, you won't have any PMI, right? Your homeowner's insurance is, a little tricky to calculate because there's so many variables. Is the house, more storm worthy? Have you installed things like impact-resistant windows, or do you have storm shutters? You name it. There's a lot of different things that you could do. Now, assuming that you did, kind of the basics and your house is pretty storm worthy, you can pay anywhere between $4,000 and $6,000 a year. It just depends on what it is. Now, if we take the high number just to be conservative, and we take 6,000 and we divide that by 12, that comes out to $500 a month, right? So we can just stick that over here, 500. Now that may be really high. I don't know. Your property taxes are going to be based on your purchase price. So a good rule of thumb is you want to be able to take, let's say, whatever the purchase price is. In this case, we're talking about $425,000. So let's take that purchase price, and what we want to do is take $425,000, and we want to multiply that by about 90%, so 0.9, and then multiply this by 2%. Okay, so your yearly could be somewhere around $76.50 for your taxes. Divide that by 12, and your payment's going to be about $638. So we'll just stick that number right here, $638,000. Now this may take you out of your comfort zone. You may not even be comfortable with this type of payment now. So it depends. So if you're looking at $34.78 total, plus, by the way, if you're in an area that has HOA fees, you want to put that in there too, right here. But let's just stick with this number, $34.78. So if we want to make sure that you're around 45%, if we want to make sure that you're around 45% of your debt to income ratio, then what we need to do is we need to take this number, 3,478, and we're going to divide it by 0.45. And that's going to give you $7,728 and 88. So let's just round it up and we'll call it $7,730. All right, that is what your income needs to be in order for your debt to income to be 45%. Now, this doesn't, we're not even talking about your total debt. So if you have credit cards and you have all that stuff, well, guess what? We got to add more. So let's say that we're at 34.78, and let's say you have, let's say you have $400 in credit card debt, plus you have a $350 car payment, and that's all that's on your credit as far as your monthly payments are concerned. So when I said $400 a month, what I'm talking about is $400 in minimum monthly payments. That's what's going to show up on your credit report, from all your credit cards, whatever they are, and they total $400 a month. It could be more, it could be less. You may not have any credit card debt. I don't know. That's what you need to figure this out. And if you work with a mortgage broker, they'll help you figure that for you. But in this case, we're doing it ourselves, so we're trying to figure that out. So total now, okay, so now our debt, our total debt service is $4,228. Now divide that by 0.45, and you're going to need to make $9,300, or basically $9,400 a month. So if you make $9,400 a month, you can afford to buy a house at $425,000 with 20% down payment on a 30-year fixed with your credit card debt. Now let's say your credit card debt is pushing you out of the range. Well, maybe you need to look at a house that's lower, not as expensive. Or you can pay down some of your credit cards so that you don't have that monthly payment. Anyway, I hope that this really helps you. This is a really good tool, by the way, for you to be able to do this. And if you need to talk to somebody that can get you pre-qualified or even pre-approved, please don't forget to let me know, because I've got an excellent lender. He's in-house. He's right here. And, we can figure out the best thing to do for you.